friends, we are here to discuss an interesting opportunity in arbitrage category. As you all know, arbitrage funds are hybrid mutual funds that generate return by using the strategy of simultaneously buying and selling of securities in different markets like NSE cash and NSE future to take advantage of price difference. This involves minimum risk since all your equity exposure is completely hedged, and unlike liquid fund, here counterparty risk or credit risk is minimum. Arbitrage funds are treated as equity fund for taxation purpose, as this fund invests at least 65% of their assets in equity, and it has the potential of getting superior return compared to short-term interest rate instruments like your saving bank account or your liquid fund. Currently, arbitrage funds are in a sweet spot and it seems attractive from the investor lens. Arbitrage fund have captured a spread of 7 to 8% in December and almost similar number for the coming series, which is much better compared to your liquid fund in current scenario. Investor can make the best use of this opportunity to invest and should stay invested till the time return continues to be better compared to other alternative options in the similar fashion. Data suggests that most of the time spreads of arbitrage fund moves in line with short-term interest rate in economy. But there are some other factors which also impact returns of arbitrage fund. As you all know, the most important factor is higher interest rate. As interest rates have increased in economy, YTM of arbitrage fund also, if you will see in March it was around 4%. Today as we speak, the YTM of fixed income portfolio is around 6.5%. Fixed income portion in arbitrage fund is almost 30% of our AUM. So as interest rate goes higher, this 30% bucket will generate higher returns for us. The second factor which impact arbitrage fund is the sentiments of equity market. In last few months, equity market, particularly Indian market, have improved significantly, with market touching new lifetime high. In line with this improved sentiment of equity market, arbitrage spread have also made a decent comeback. Rollovers this month has happened around 70 to 72 basis point against average spread of 35 to 45 basis point in last few months. One more factor which is aiding arbitrage spread is its inverse relationship with AUM of arbitrage category. In last 6 to 8 months, we have seen redemption of almost 30,000 crore in this category because returns were not that attractive compared to higher returns which were available in liquid fund and other fixed income category because of spike in interest rate. As AUM was going higher and higher, we saw that it was putting pressure on spreads and return was going on the lower side. Now this lower returns has led to redemption. As we see more and more redemption, automatically that pressure on short side has gone down significantly, and this lower pressure is now aiding short rollers to generate better returns. So this is the third factor which impact arbitrage fund. Now the last but not the least, or I will say the most important factor, is the HNI and retail long open interest. During this correction from April to June, open interest of HNI and retail category from peak, you can say from peak of 1 lakh crore has gone down to as low as 60,000 crore. They are our largest counterparty because they are on the long side, and as an arbitrager we are always on the short side. Now with this sharp recovery from, you can say, middle of June 2022 till date, our markets have made a significant comeback and we have made new lifetime high. In line with that, long open interest of HNI and retail have also come back, and from bottom of 60,000 crore they are already at 85,000 crore. Going forward, as investor sentiments turn more bullish, we expect more and more participation which will help long leverage position in stock future, and that will increase probability of generating higher returns for us significantly. In addition to this, there are some more factors which will be helping arbitrage fund to improve their performance going forward. The most important will be, as we move into the last quarter of the, you can say, financial year, we expect more and more PSU companies to announce dividend. This dividend will be like an add-on to, you can say, generate higher returns in Jan, Feb and March quarter. Similarly, as we move closer to financial year end, we will see liquidity get tightening into the market. Normally in March, we see a spike in interest rate, which will help us to generate better return, because this spike in interest rate will help us to generate better return on that 30% of our fixed income portfolio, as well as this will give a kicker to the spread of cash and future also. In addition to that, I think the most important factor which can play out in next 3 months is balance advantage fund, or you can say the hybrid category. Today, most of the large hybrid funds or large balance advantage fund are running lower equity exposure because market valuations are expensive. They are already running, you can say, equity exposure which is towards the lower end of their equity band. Going forward, if at all their signal flips, we will expect a short covering coming from them. This will reduce pressure on the short side because a large chunk of short position is sitting with balance advantage fund and other hybrid funds. So as soon as this will lead to some, you can say, short covering, this will further help arbitrage fund to improve their spread. As we have already discussed, factor which helped arbitrage fund to generate better return in last couple of months, and some of the factors which will definitely play out in next quarter. Anyone who is looking to park money for the short term, say next 3 to 6 months, should definitely take maximum advantage of this opportunity. If returns for your first couple of months is in the range of 7 to 8%, that gives you a significant cushion to stay invested for a longer period of time. That's all from our side. Happy investing. Happy New Year. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.